All right, Doug, take it away.
Welcome to Loothing for Dollars, everyone. This is our monthly little get together where we talk about the dollars and cents side of loothing. We normally do this as a roundtable discussion. Today, we're going to do a little bit differently. We're doing Franklin Linker and I are going to do a little bit of a one-on-one chit chat, uh, given the subject matter, partially because he was the only person I could find that actually wanted to talk about taxes. Welcome, Franklin.
Thank you.
So, we normally do a roundtable discussion about the business side of loothing, and we usually pick a subject and then dig deep with a panel of looths. This is a little different one where we're doing the one-on-one, like we said, because we decided because it's tax season, it would probably be a good time to talk about that. If you have an LLC or an S corp or a corporation or something like that in the United States, and you haven't done your taxes yet, they're due tomorrow. So maybe you want to stop watching us and get to that. I did my taxes earlier this week, and we're going to talk a little bit about the whole subject of taxes. This is not so much a conversation about how to do your taxes as much as a we're going to try to unpack as much we can in terms of if anybody has any specific questions. We can answer as many of them as we can get to, but it's going to be a broader discussion of the concept of taxes. And I apologize from the beginning because it's going to be a little bit U.S. centric because both Franklin and I are in the U.S. and probably know mostly about that subject. We're going to try to have somebody on in the future. I was talking to Andy Charles about helping me find someone who can come on and talk about the European side of taxes, VAT taxes, and all of that kind of stuff. And we'll try to do something like that in the future. But I'd like to welcome Franklin Linker from Linker Guitars to us with us. Franklin is a Luth out of North Carolina. You've been running a loothing business for what, like 15 years or 10 or 15 years, something like that?
Well, I've been on my own for 9 years now.
Okay.
Before that, I was working at Collings Guitars.
Mm-hmm.
So I've been in the business, just strictly doing this for about 15 years now.
Mm-hmm. Yeah. And so the reason we're talking about taxes today with you is because you're also a recovering accountant.
Yeah,
right?
I burned out on that a few years ago.
So let's talk a little bit about that and your history with that, because I know you were an accountant. I don't know much about the history of it. So why don't you give us a brief synopsis of what your background in accounting is, and then how you came to loothing from there.
So my degree is, I have a degree in business administration with a concentration in accounting.
Mm-hmm.
And I graduated in 1994, so it's been a few years. And at first, I didn't really do accounting. I worked for a marketing company that was family run. And then later on, I part of my job is at the marketing company is my wife and I lived overseas in Israel. And then I continued on with that, but then we moved back to the States. And after a while, we decided we wanted to move back. And I got a job as the financial coordinator for a nonprofit that had offices worldwide. So I just kind of made my way up in that nonprofit. So I learned a lot about helping to manage people as well as reorganize all the books for that nonprofit and then present everything to the Israeli government for audit each year. So I got a lot of, I guess I would call, it's accounting, but also just some really strong bookkeeping knowledge.
Mm-hmm.
Now that was in a nonprofit situation, but once once I opened my own business for myself, it wasn't a problem. I mean, some concepts change, but all the bookkeeping is very closely related. So I went from there.
So when you decided to get into Loothing with that kind of a background, the business side of Loothing was kind of a no-brainer for you, I'm guessing.
Yeah. Yeah. From day one, I had used in Israel. I'd actually used SAP, which is a really huge accounting software
Mhm.
that would do multi-currency. I was buying and selling currencies because we got donations, and this was even before the euro was a thing. So I had like 20 to 25 currencies to maintain and manage, and you needed a really robust accounting system to do that, to know when to buy and sell, just to maximize your money. And it just did about everything. So um, when I opened my own business, that was a lot simpler. All I had to do was deal with dollars and use something like QuickBooks, which is really, I would understand if somebody just sits down and starts using QuickBooks, they might get a little bit lost. If they don't have any accounting experience, certainly they'd be like, okay. Um, but for me, it was like, oh, okay. It was just kind of learning just some small things within QuickBooks to know, because the system I was using before was much more manual.
Right.
I got frustrated because I couldn't do, QuickBooks is helpful if you don't know as much about accounting and kind of steers you in a certain way. And I was used to doing a lot of journal entering as well to fix, irreconcilable differences or currency, write off changes in currency, like small amounts, stuff like that. So, but, you know, so yeah, I mean, the accounting part was the easy part. Learning to interface more with people and deal with their guitar problems when their guitar was more important than sometimes their family members was the real challenge.
Yeah. So before we start talking specifically about taxes, I'm gonna take a little bit of a liberty now to talk about my background because I don't have an accounting background, but I've been doing my business's taxes for pretty pretty much almost its full existence. Um, and I know about taxes only from and accounting only from having to have done them. And I started Loothing when I was in college. I put myself through college um, by Loothing and working on guitars, and it was one of the ways I paid my way through school, along with being a musician and a variety of other things. And when I was leaving college, after I left school, I got a job in a defense electronics company, and I was there for 2 years as an employee. Started working in the stockroom, and I worked my way up through middle management into management. And that was my first experience in life as an employee of a big company. It was a defense electronics company out in Long Island, and they had a one of the benefits they gave to their employees was every January they would hire a tax preparing service to come in and set up, in the cafeteria and let employees sit with them and have them do their taxes for them. And they would tell them what they owed or tell them what, they were getting for a refund or what have you. And it was just part of the perks of working for this company. They provided that. I left that company 2 years after working for them and started Loothing, among other things, as well as playing guitar, teaching guitar, and be, becoming a full-time troubadour of sorts. Um, and suddenly found myself uh, at the beginning of a year not knowing what to do with my taxes because I was no longer working for somebody else. And as an adult, so one of the first things you have to deal with is, of course, taxes. So I had left that job early in a given year after the previous year's taxes had done had been done already. And I left early, like in the spring of that year, and started. I was gigging full time. I was teaching guitar. I was working on people's instruments. I was taking instruments in from music stores and repairing them at home. So I had all of these different sources of income related to guitar that um, were coming from all sorts of different sources that all had to be accounted for differently. And I just wasn't paying attention. I was too busy trying to learn how to run my quote unquote business. And at the time, I didn't even consider it much of a business as much as I considered it what I just did from day to day to earn money in order to avoid getting a day job because I had just left a day job. And I get to the end of the year, and then the tax season begins or the calendar year ends, and you start thinking, oh my goodness, I have to file a tax return. And I went into an H&R Block, sat down with somebody who looked at me like I had seven heads because I didn't have a W-2. I didn't have this. I had a few random pieces of paper, some receipts and other stuff. And they kind of looked at me and said, well, we really don't do that here.
Yeah.
Um, And so I started asking some friends of mine. I worked in a band with a bunch of guys at the time, and I turned to the bass player and I said to him, I said, what do you do about your taxes?" And he says, "Oh, that's easy." He says, "We got a guy. Everybody's got a guy. I go to a guy, and he does my taxes for me." And I said, "Okay, you go to a guy and he does your taxes for you?" He says, "Yeah." And I said, "Then what do you do?" He says, "Then I go over to my in-laws' house and I ask them to borrow money so I can pay the taxes I owe." So I
Yeah.
wasn't married at the time, so I didn't have any in-laws to go to. So in asking around, there was a guy who was I was teaching at a couple of different music schools, and there was a drummer that I had met and worked with occasionally and he had a bunch of different sources of income, kind of like I did. And I said to him, I said, "What do you do about your taxes?" And oh, actually, no, he overheard me talking to somebody else about what I was going to do about my taxes, because this was a conundrum that I hadn't even, considered, and I'd gone to HR Block, and that didn't work out so well. And so he came over to me and he handed me a business card, and he said, "Go see this guy." I said, "Is this your guy?" He says, "Just go see this guy. He'll screw your head on straight." So I went to this guy. His name was Rob Worthy. And I forget the name of his business, but he was an accountant. And so I went to him I suspected that I was going to him, or I presumed that I was going to him because he was going to help me do my taxes. And I sat with him, and he looked at my scenario and saw, my box of receipts and I had some bank statements. I had a 1099 from somewhere. I had all of these random pieces of paper without a clue as to what I was doing. And he said to me, he says, "We can do this one of two ways." I said, "What's that?" He says, "Well," he said, "you can give me $1,500 and I'll do your taxes for you." And I said, "Okay." I said, "What's the other way?" I didn't have that kind of money. And he says, "Well," he says, "the problem you have is you have no idea what's going on with your business." And he says, "Well, we can do it that way where I can do everything for you. It's going to cost you a fair amount of money." And he says, "And at the end of it, I can tell you how big a check you're going to have to write to the government." He says, "Or," he says, "I can show you how to fill out your taxes for you, and you can fill them out yourself. I can teach you how to do it. I can give you some pointers on how you need to keep your books, and we can move forward from there." And I said, "How much is that going to cost me?" He says, "You can pay me what my hourly rate is." I forget what it was. I think it was 50 or $75 an hour. He says, "You can pay me my hourly rate for how many hours we meet every time we meet, whether that's once a week, once a month, what have you." And this was in the end of January. He says, the good news is your taxes aren't due until mid-April. So you have a couple of months to get this together before you have to file your taxes. And I said, that sounds like a better plan to me. So we decided to do that. And so he would send me home with these homework assignments. And throughout the years, I would learn how to do not only my taxes, but the bookkeeping necessary to do my taxes. And then as time went on, I just took more and more of a role in doing my own taxes. And I got to say, that was the best experience I've ever had in business because it set me on a glide path for being able to not be at the behest of someone else in order to file my I didn't need a guy.
Right.
And the what I didn't understand about running a business as it relates to taxes, and taxes to me, looking back on it, is um, the embodiment of the end result of what you should have been doing to begin with, which is accounting, in your business. Um, so that's just my background isn't so much in schooling as much as it is in just the hard knocks of having to figure this out. And I had somebody who looked upon me as, I don't know if he was looking upon me as a charity case or if he was looking upon me as just his way of being able to, pay back his debt to society. But he decided to give me the opportunity to learn from him how to deal with this myself rather than constantly be at the behest of somebody. As my business grew, I always made sure I had an accountant because when he retired and I moved on, when we incorporated in the early 2000s, I got a corporate accountant to work with because there were things I didn't understand. And I always wanted to make sure, and I've talked about this before as it relates to Loothing for Dollars, that I'm a huge believer in having a board of trustees that I rely on that have expertise outside of my world as a business owner. So I have an attorney. I have a firm that does all legal work for me that I can't necessarily do myself, and I rely on them to advise me when I have something legal going on with the business that I need advice on. Same thing with accounting. I do all my own accounting. I do all my own tax filing. I schedule an appointment once a year with my accountant, and I hand him our taxes, and I say, "Here, take a look at that, read through it, and tell me how I did." Um, that continued on for many years, and I would meet with Rob once a year and go through my taxes, or once a quarter if it was trying to deal with quarterly taxes in the beginning. And I would sit down with him and let him pour over my taxes once a year and give me advice as to how I should be handling it compared to what I was handling before I signed them and send them off. And that's the way I learned how to do my taxes. And I've done pretty much all of our own filings um, ever since then. Um, so that's just a background from where I'm coming from. And it strikes me that the guy who went to school for accounting actually relies on somebody else to do his taxes for him, and the guy who didn't probably should but doesn't. Um, I don't know what that says, but maybe it says more about the fact that you you hated it more than I did.
But it's not a love hate thing. Well, part of it was I have done our own taxes before. Uh, what I do now is I pretty much I get everything ready, and I know where everything needs to go, and then I just give it to her to put it in, and then she sends it back to me, and I'll look it over, and if I have any questions, then I'll just sign off on it. Um, for me, it's I guess a time thing. I already spent enough time at the shop, and part of that is not delegating some things. I decided that there were other things that I was willing to delegate and not have to look
Mhm.
at so closely.
Right.
But I think that's amazing that you do that. And my hat's off to you. Not
Well,
that I
like I
couldn't
said,
do it, but at this point, I'm just like, well, that's something that having another set of eyes look at and then take it and fill it out, then I can check it over. It works for me.
Well, I'm assuming in your case, you do your bookkeeping yourself. You're not having somebody else do the bookkeeping part. You're doing your bookkeeping
No.
books, and then you pass off like a QuickBooks file to your accountant for them to take that data and put it into the form.
Well, yeah, I mean, with QuickBooks Online, the accountant that I use, I know her really well. She also has access to my QuickBooks. So she can go in and make changes. Like if I tell her, hey, this is what I've done and this is where I'm putting this, hardly ever does she say, no, don't do it that way. But if she does, then either I go in and change it or if she can. So it's just nice. That's one of the things I do like about QuickBooks Online. I don't like the continuing rising prices and things, but the prices of everything have gone up. So
Right. And we can talk about the day-to-day part of it in a little bit. Um, another person by the name of Franklin, as we start to talk about taxes, Benjamin Franklin famously said, "In this world, there was nothing that can be said that is to be certain, with the exception of death and taxes." I
yes.
think probably predicting when you're going to die is probably easier than predicting how much you're going to have to pay in taxes, every year.
Yeah,
Uh,
the actuaries will figure that out for you.
right? Wasn't it Will Rogers, I think, who said that the only difference between death and taxes is that death doesn't get worse every time the government body meets. Okay.
I like that. That makes sense.
So if we're going to talk, we're going to start talking about taxes generally first. Let's start looking at the type of taxes that people have to deal with day to day, year to year, month to month, quarter to quarter when you're running a Loothing business. Um, it's the kind of thing that I think we all have to deal with in what way suits our way to approach it. I'm the kind of person who's super hands-on when it comes to stuff like that, partially just because of the experience that I described earlier. Um, uh, but let's start talking about the different type of taxes that somebody's going to do. Of course, right at the top of the bat is income tax.
Yeah.
Let's unpack that a little bit. When you're paying income taxes on the money you're making as a Luth, you're either going to be dealing with income taxes from the standpoint of, as an individual, if you're working for someone else, you're getting either a 1099 or a W-2, and you're getting income reported to you, and then you're just filing your taxes based on those forms. You either have withholdings or you don't. If you're a 1099 employee, I don't want to get into the weeds of the difference between a 1099 and not. That's, I think, what a lot of outfits are using as an excuse to not have to do withholdings. They'll call somebody a independent contractor, whether they are or not. But if you're if you're paying income tax, you're either paying income tax in what forms when you're, taking income in and when you're lifting.
Well, are you talking about from your sales?
Well, we're talking about from the standpoint from income. I'm thinking about the difference between, somebody who's a sole proprietor versus
Right.
somebody who's
Okay.
got a business,
Yeah, you're set up as an LLC,
right.
partnership, S corp, C corp. If you're big enough, I find it. I don't know. Not too many of those in a small Loothing community, I would imagine.
Right.
But as an S corporation or an LLC are probably your most prevalent, or sole proprietorship if you're not worried about the liability exposure of your personal assets. Maybe you just set up as a sole proprietor with a DBA
Mhm.
doing business as whatever
And
your
and
guitar company is.
I suspect that's probably a decent proportion of, those in the Lutheran community. If you're working from home and you're especially for those who are just embarking on this, there's the tendency to just kind of do what I did, which is I started off that way where, somebody brings you a guitar, they give you the guitar, you do stuff to it, they give you money, it goes in your pocket, and you're quote unquote in business, and then you have to figure out how to account that for later. That's the essence of sole proprietorship. That means that you're
Right.
getting income directly from people as an individual, and there is no separation between you and the business. That you are the business, and your income is coming directly from that activity. But
Correct.
you need to report that income on your 1040 um, annually, and you, of course, the deadline is in April. Uh,
Right.
so when you're doing that, the the essence, you would be doing that on a Schedule C, if I remember that correctly.
Correct.
Not E.
Correct.
So on a Schedule C, um, and that's named a Schedule C because that's where it shows up in the tax code under business income. Um, the whole concept there is that you're reporting income after you're reporting gross income. You're then reducing that income by the expenses of the activity you're involved in, and you're paying money on the profit that's left over.
Correct.
Okay.
That's where you pay the rest.
Come again?
No, I'm just saying, then whatever's left over, you can just hand it in.
Right. Um,
No, I'm just being facetious, but
so with that, that's probably the closest thing you can be to flying without a net. Um, and that's the way a lot of small businesses operate. That's the way I operated for a number of years. That's the way I first learned how to do my taxes, by learning how to file my 1040 and learning how to fill out a Schedule C. Um, the challenge with that is to separate you from your business. Would you disagree?
no, that's a very big concern, and you know that's why doing something like at least doing a DBA to kind of give you a little bit of delineation, but then also the biggest thing you could do, whether you're a sole proprietor or any type of business, is then have a separate bank account for all those transactions, a separate credit card for all of those transactions that you need to purchase things, um, and then and make some type of attempt at accounting for all that. Whether I say at the very least, get a spreadsheet and keep track of it that way. Um, and reconcile your bank account and your credit card statement if you're going to do it that way,
Well,
and report everything.
yeah, I have often said during some of these looting for dollars things that the most important step, if somebody's looting as a business, the first thing you can do, if it's the only thing you do, is that you set up a separate bank account for your business, get a separate credit card for your business, whether or not a credit card company will give you a credit card in the business's name. That's very hard to do if you don't have a formal entity for the business.
Right.
But just get a separate credit card, for, Doug Proper, and you call that one your business card, even if you have to stencil it on the front, just for the sake of reminding yourself that you don't buy your Friday night pizza with your business credit card. But if you do have at least a separate business checking account for your business and a separate credit card for your business, and you do two things, which is one, make sure that every dime of money you make from Loothing, whether it's cash from a customer, a check, Venmo payment, PayPal, anything, every dime you make from that activity goes into that bank account. And every expense you have as a result of the business activity comes out of that bank account, either in the form of a payment out of that particular account, or if you use that business credit card, you then only pay that business credit card when you get your monthly statement out of that account. So by definition, you have a single account that all of the money funnels into and all of the money comes out of. Then by definition, your monthly bank statement becomes a profit and loss statement that you get 12 times a year from your bank,
Exactly.
you know. And that, if you did only that and you had somebody else doing your taxes for you, and, you know, if that was the only thing you did, you would have at least an accounting of all of the dollars and cents that came and went. The problem there, of course, is looking at a bank statement, you see check number 2052.
Exactly.
What it's for is then the challenge of doing what the world calls accounting. You have to count for what that was for, what business use it was, and what, what expense it went to pay, whether it was a check, to buy, some wood out of a trunk of a car like Danny did this afternoon. Or, whether it's, to pay for a tool from Stu Mac or supplies from All Parts or whatever. If it's a payment to run your business, then the accounting part is categorization. It's giving those dollars a name. Where the income came from is, depending on how many sources of income you have, is also another part of that accounting.
That's right. And, the other important part is you don't need an accounting software to keep all your receipts, and now, especially because, one other thing I'd say maybe to delineate yourself would also be to set up some type of email. Purchases that I make, most of those now come with an electronic receipt. So, I mean, it's great. I keep all my paper receipts. I'm old school, Gen X. But beyond that, I also have a computer backup of all those receipts that I can match with my bank statement or match it with my credit card statement. Or if I were to write a check or an e-check or whatever, that I've got all that there, and it's easily trackable. If you were ever audited, you've got all your backing documentation, and hopefully you've got, like, I also have one of these. It's called a Scan Snap. It's the scanner, and it'll scan. It would scan an ID card. It'll scan almost anything and compile it into a PDF file. And I just thought, oh, that's really cool. Makes it quick, especially for the things that I purchase for the business that don't necessarily come with um, an electronic copy. And then I can just bring that in and put it on my computer and then back it up to the cloud. So I've always got it.
Mm-hmm.
Anyway.
So, so that whole the record keeping part of it, like I said, it's the kind of thing where you gotta figure out where your comfort zone is. I've been a QuickBooks user since I think 1986. So, or whatever the first year that QuickBooks came out. I tried a piece of software before that called Peachtree Accounting. It was a little bit cumbersome, and at the time, I think my computer was probably too slow for it. So it was causing all sorts of issues. And somebody hit me to this thing called QuickBooks at the time, and I started using that. And I've been a QuickBooks user ever since. I don't use QuickBooks from an automated standpoint where the transactions are automatically downloaded into your account. But that's certainly available to a lot of people, and to most, that's probably the way you would either want to or should do it. I've been using QuickBooks since the days prior to them actually automatically downloading transactions. Automatically downloading transactions was a new feature that came out with the upgrade from one year to another when I was using it. And I had gotten so used to putting the information in for myself that I just maintained the activity of manual input ever since. Every time I had the idea of saying, "Oh, I should have it automatically downloaded," I would get this sense of terror because I was worried about the conflict of information coming into what I was already putting in. So I just kept manual from the standpoint of it was easier for me to conceptualize that it went in, and then it just became part of my daily business routine. Um, but the keeping track of the money coming in and the money going out, the categorization I found was the thing that was the most cumbersome part of finding a way to do it that made sense to me. Also, the activity of doing my own taxes every year gave me the appreciation of how to categorize those things so that they would line up with the tax forms
Exactly.
when they
Exactly.
and you learn how to adjust.
Right. And, you know, that's one of the things that I was just going to say, and you brought it up, which is perfect. You can look at whatever you're using, whether it's Schedule C or um, the form 1120S,
Mhm.
those different forms you're going to use for the whatever you are, LLC, corporation, sole proprietor. You can see how the government kind of expects that to be reported. And, you know, even if you're just using a spreadsheet, um, you can make, you can build it in such a way you can couple all those. Like, even if you want to be a little more detailed with your accounting, maybe you do, maybe you don't. But like me, I'm always about the detail if I want to run reports. But I have created my chart of accounts to mirror what is going to be on, you know, my filing.
Mhm.
And so that makes it easy too. That's why I don't have to pay my accountant much when she does the filing.
Right.
You know.
Yeah, exactly. And I think that activity forced me to learn the accounting side of it, or forced me into a situation where I was trying to align the accounting with the categories that would wind up on the tax forms.
Right.
Now, you mentioned the 1120 filing, which, for those who don't know, that's the file, that's the form. You know, if you're not, if you're set up as an LLC or a partnership or an S corp or even a C corp, the 1120 is the form that you would be filling out for the business, because in those circumstances where your business is a legal entity outside of yourself, um, you have, from the standpoint of the government is concerned, your business is its own entity. Your business is a taxable uh, entity that earns money with or without you, and that is responsible to pay its own taxes and report its own income. Those LLCs or partnerships or S corps are all considered pass-through entities, that the income from those activities flows into the business and then passes through to the person who is the shareholder, or the partner, or the shareholder in the corporation, and then reports those on their Schedule C through a K1 form, typically. Um, do they use K1s in LLC,
Yeah, for a partnership.
for partnership?
Well,
K1, yeah. Um, so in those circumstances, an S corp or an LLC has its own income and its own expenses, and you report those very much the same way on the companies or the corporate tax form, which is an 1120, 1120S. Um, does the S stand for S corp, or is that just 1120?
it stands for S corp.
S corp.
I'm
So
pretty sure.
yeah, the 1120 is the general term, and then they have the 1120C, 1120S, and so forth and so such. Um, and that the whole concept there is that the business entity is responsible for reporting its income and expenses, and therefore whatever taxes would due would then pass through to the shareholders, and those shareholders then report that on their 1040 through the form of a Schedule K1. In those circumstances, anybody who's thinking about organizing their business in the form of an S corp or an LLC or something, one of those types of organizations, if you currently only as a sole proprietor, there are benefits and there are disadvantages to both. One of the biggest disadvantages, of course, is that suddenly you have two tax returns to fill out every year, or at least there are two tax returns to deal with. You have a tax return that's due for the corporation, and then you have a tax return that's due for you as an individual, as the owner or shareholder of the business. Because there is no such thing as an owner other than shareholders. You could be a 100% shareholder, but the corporation is responsible for filing its own taxes and then reporting that income to the shareholder, which then you have to report that income on your 1040. So, the first, when we incorporated thankfully we incorporated during the summer of the year we first incorporated. So I had a little bit of time to figure it out. Suddenly the following year, we were faced with the notion that I had instead of my taxes being due on April 15th, like they were every year, suddenly they were due every March 15th and then April 15th again. So suddenly we had two tax returns to fill out. It did make the 1040 a lot easier to fill out because Schedule C's disappeared, and all of that number crunching for Schedule C's, disappeared into thin air, and it became a much simpler form to fill out. But trying to navigate the 1120 for the first time was a little bit of a chore. It was a new experience. I've grown used to it because we've been filing 1120s now for 24, 25 years, something like that. What would you say are the biggest differences between being a sole proprietor from a tax standpoint and being an entity, whether it be an LLC or an S corp or corporation?
Well, the sole proprietor versus an LLC. With the LLC, you're going to get like an employee ID number.
Mm-hmm.
That's gonna help with building credit for the actual company. Although they will use your personal credit. Like I've applied for things, they'll check your personal credit, but I also have credit through the LLC, and so they see that and they'll grant me more credit or whatever. It's really the liability, the protection of your personal assets. Especially for me, I have a business, I own a building, I also own my home. So I want to make even more of a delineation and protect my personal assets from should something go wrong with the business, and heaven forbid you'd have to declare bankruptcy or someone come after you with a liability lawsuit, although I do have liability insurance through the LLC.
Mm-hmm.
That they couldn't take your home, your personal home, or any of your personal assets would be protected from those type of things. The S corp, that's the drawback. I would say with the LLCs, you're paying both parts of your self-employment tax,
Mm-hmm.
and you don't get to deduct it.
Mm-hmm.
Whereas with the S corp, if you're paying yourself, you're actually an employee on an S corp. Like when I take what's called an owner's draw as an LLC.
Mm-hmm.
So you're actually running a payroll tax, and you're technically an employee of the company. You're going to pay your part of the self-employment tax as part of being paid or getting your paycheck. The S corp is going to pay, but also have it as a deduction. So it will save you money. and I don't know the fine line. One thing I spoke to you about this video that I saw that Rick Beato did,
Mhm.
and I, I haven't looked into it. It's like I'm getting to the point where I have to start making that consideration. What do I do? Do I stay as an LLC or do I change to an S corp?
What do
And
you,
that's about
what do
at
you,
least in this year's computation. If you're running a profit of about $150,000 on your business,
right,
then you can start moving to an S corp.
right.
Um,
So are you, by
I-
the way, are you an S corp or an LLC? I didn't catch that. Are you an S corp or an LLC?
Are you talking to me, Doug?
No, I was talking to Franklin.
Oh, okay.
oh, me? I'm sorry. I thought you said Joe.
No.
I'm an LLC currently.
Okay. So you're in the process of deciding whether or not you're going to go S corp.
Yeah.
Yeah, and I do think there is an additional layer of liability shield in S corp versus LLC. There is also, like you said, the deductibility aspect. We decided to become an S corp when we did, rather than an LLC, primarily just from the advice at the time of our attorneys, because it coincided with us moving our business into a shopping center, which meant that you were in this big outdoor shopping center, which means that if somebody comes out of the dog groomer across the way and their dog bites some third party and you just happen to be within, viewing distance of somebody else's misfortune, you could wind up being a target of somebody's lawsuit because lawyers like to sue everybody who's on the block.
Right.
We were looking for just that extra degree of separation that an S corp provides. I will say the difference to sum that up, the difference between and from my view of it, the difference between a sole proprietor and whether it be an S corp or an LLC or some other business entity is not just the degree of separation versus liability, and that's a big deal because you give yourself a shield between your personal assets and the business assets. If somebody decides to sue the business, there's only so far that they can go in terms of attaching any assets to whatever kind of a judgment that they could get. Beyond that, they would have to pierce the corporate veil in order to be able to attach um, your personal assets. And that's a pretty high threshold to get to. You do have to make sure that you do things properly. You have to have an annual corporate meeting. You have to keep minutes of those meetings. You have to do those few little things just in order to make sure that your ducks are in a row so that some crafty lawyer doesn't wind up being able to ruin your life just because you got lazy. But if
Right.
you do just those certain things the way you're supposed to, um, things that corporate shield, that corporate veil is very difficult to pierce. But the second part of that, the idea behind that is that the degree of separation it gives you between your personal finances and your business's finances is um, that much more opaque. In other words, um, the that if you're running like if you go to the county clerk's office and you get a DBA for your business, Doug Proper doing business as DBA, as I fix your guitars, and that will let you open up a bank account for the business. That will let you even possibly apply for a credit card, although most of the time you would probably be denied for it. And even if you do have an LLC, very often you're going to wind up having to sign a personal guarantee anyway.
Right.
But the degree of separation between you and your personal finances becomes that much more concrete and that much more separated, merely from the sake of the fact that the income to the business has to be reported separately. And the expenses that business accrues and accumulates has to be reported separately through the 1120S. And the deductions for those expenses comes from the business and has to be reported separately. There are other tax advantages that you could take as a result. Do you understand where I'm coming from, Franklin?
Oh yeah, absolutely. I mean, you're right. And, there are certain deductions you can take when you purchase equipment that you can either depreciate or amortize, or use Section 179, which lets you completely expense that in the year, even if you're financing it.
Mhm.
So you can take advantage of things like that if you're set up as a business.
Right. So, and what I'm referring to in terms of the income and the expenses in terms of the businesses, if your business is reporting income, and then and just to put it in a nutshell, the whole concept behind having to deal with income taxes, whether you're dealing with it from a corporate standpoint or a sole proprietorship, is that you report all the income. Theoretically, you report all the income you make from an activity, and all of the expenses in order to generate that income reduce the tax liability of that income, reduce the reportable income. So if you make $100,000 fixing people's guitars, but you wind up spending $50,000 in order to make that $100,000, you have what would be left over $50,000 of taxable income. If you're doing it as a sole proprietor, it becomes much more difficult to separate the expenses that are accrued or incurred, which is the proper word, I think, incurred by you versus incurred by the business. Even if you do keep, and if you keep a separate checking account, it's easier. But here's an example. If your business entity is your, Guitar Repairs LLC, is accepting income from people as you're repairing their guitars or as you're selling guitars, and your business, and you wind up going to, say, a guitar show in order to sell those guitars, see other guitar players, see other guitar builders, participate in those events for the purposes of furthering your business. As an individual, if you pay for a hotel room, it's very difficult because the rules by which you get to deduct those meals, the travel expenses on a Schedule C are different than the corporation's ability to do that. Because if you're the individual who works for the corporation, you become an employee. It's no longer Doug who's fixing your guitars. I'm Doug who works for the guitar specialist. The guitar specialist purchased my hotel room for its employee going to that guitar show. And as a result, it's 100% deductible. You try to do that on a Schedule C, your travel expenses become diffused by how much of it is affected by your personal use and meals and so forth and so such. See where I'm coming from?
Yeah, that's right. That's correct.
Is that a good analogy for that?
Yeah, I think so. And even, thinking about things that you're totally allowed to do. I mean, I guess even if you're an S corp, but thinking about things like using your personal home and having a home office, just delineating that and making sure that you keep really good records so that if you are audited, it's very clear, that that you have kept track of it, and then it's legitimate and not you just trying to get a little bit more money off of off of your taxes.
Right, right. Well, that whole labyrinth and we're going to talk about that when we get to deductions. So that's in a synopsis, that's talking about income. I want to move past income taxes because we're at the section where we're talking about the different types of tax you have to deal with. The other kind of taxes somebody has to deal with typically is sales tax. That's something that is going to be different depending on where you live, because every state has its own rules regarding sales tax. Sales tax is going to be different in New York versus, another state, Florida, Wyoming, wherever. I don't. What are sales tax rules like where you are in North Carolina?
Well, each county in North Carolina will have its own tax rate, sales tax rate, and that's coupled with the state tax rate. For me, being in the county I'm in, I'm paying a total of 7%. It's 4.25 for the state, and then the remainder 2.75 for the local tax. And just about anything you can think of, unless you have a special exemption, is going to be taxable. Like for me, the very month that I opened my business was the first month that service was taxable for sales tax in the state of North Carolina.
Okay.
So lucky me. Everything became 7% more expensive. I also have inventory. I sell retail goods, pickups, all that stuff. It's all subject to that 7%. And I file monthly, but depending on, and I don't know exactly where the threshold is, but when I first started, they make you fill out a form where you guesstimate about what your sales will be.
Right.
And so then they said, well, then you're going to file monthly. Some people file quarterly. If you're like a cottage industry or a seasonal thing, then you're only going to file for the season that you're open, pretty much.
Right. And,
So,
the thresholds for those things is going to change from one jurisdiction to another. So the whole concept behind sales tax is that, and this is something I tell my customers merely for the sake of the fact that I don't want people to get mad at me. We live in a world for some reason that seems to defy logic. We all grew up stumbling into music stores and asking the guy, the sales counter, if I pay cash, what's the price? As if there was some magic that was taking place, asking an employee of a business to admit that they're breaking sales tax laws. But that's and it's a common thing that for some reason guitar players are trained to do that in the floors of what used to be Sam Ash and Guitar Center. But one of the things I make sure to tell my customers is that I'm not charging sales tax. The state is charging sales tax. I get to collect it from you because, in essence, you become an agent of the state, and you you receive a sales tax certificate that grants you authority to collect sales tax on behalf of the state. And that's exactly what's taking place. Is your state has decided that every financial transaction or whatever they are, I think in California, I've heard from our California buddies that in California, the service is not taxable, but the product is. And I don't know if that's the case. I think that's what I've heard. But if you're installing a pickup in somebody's guitar and you're selling them the pickup in the transaction, that the purchase price for the pickup is taxable, but the service for wiring it in is not. That's maybe specific to that state. That is certainly not the way it happens in the state of New York. I think in the state of New York, if you drive below a certain miles per hour as you're going down the street in front of my shop, it becomes a taxable event. So, but in New York for the longest time, and there was a period of time prior that when we were charging sales tax and collecting sales tax, that only the only the service, only the product was taxable and the service was not. And then, of course, politicians being as they are, always wanting to increase revenue to the state, decide that, hey, if we just make all services taxable as well, we can generate more revenue. And then, so then at a certain point,
Exactly.
the sales tax was then extended to, to the service that you were providing. So in our sense, it's in New York, whether or not it's a service or and oddly enough, when we were running a music school, music lessons were not taxable at one point because the definition was that if you were providing information to a customer, that if the information was individual in nature, then it was a non-taxable event. Well, I can't think of anything more individual in nature than teaching somebody music, because I'm not going to teach the same thing to this person as the next person who's sitting next to me, unless I'm just telling everybody, put your finger there, hit this twice, hit that once, hit that again. And if you do that enough times in a row, it's Sweet Home Alabama. Unless you're doing that for teaching music, then it's in essence, it would be individual. And I believe, I don't know if since we closed our school in 2002. So I haven't kept up with that part of it. I don't know whether or not it's become a taxable service or not, but I suspect it probably has, because given enough time, they'll tax everything.
Yeah, our state will periodically send out letters, kind of reminding you what is subject to sales tax. But I've always just several times picked up the phone and actually called the sales tax office of the Department of Revenue and talked to someone. Around here with the community colleges, the North Carolina Department of Revenue will actually give free business meetings where you can take every question you have, whether it's even about income, state income tax, but also the sales tax. The other thing that we have, and I don't know if you have to deal with this in New York, is what is called use tax.
Yeah, they do have a use tax. You want to explain that?
Well, I know for myself, I get a sales tax exemption from different vendors because I'm going to be reselling goods. Like, so I sell Diodario strings. So I have a special form from the state of North Carolina that I fill out. I send that to Diodario and they're like, okay, great. Now you're set up. When we ship to you, we don't charge you sales tax because you'll be collecting it in your state.
Right.
Then when I sell those, then I charge sales tax. However, if I decide that I need a set of strings to use in the shop for who knows what, maybe, I need to set up something to show to a customer or whatever, and I use internally that set of strings, I have not paid sales tax on it. So the North Carolina deems that usage tax. So what I do is anything that I purchase that doesn't get used or sold, I should say, will then be subject to use tax, and I have to self-report that and take it out of my inventory. Maybe I'm buying something for the shop. I mean, Diodario, just for an example, or even StuMac. Everything I buy from StuMac, I have a sales tax agreement with them, but I buy tools from them. When I buy those tools, I pay the use tax on my sales tax form each month.
Right.
Whatever portion I didn't resell has to be reported as use tax.
Right. Yes. And they have the same thing in New York. And they're in, I think, a good number of states that are getting into the use tax arena. But there are some states that don't have a sales tax. So that's, but if one of the benefits, of course, of being able to set yourself up as a sales tax entity is that you get to, buy things pre-tax if you're reselling. So it saves you a little bit of money there and it saves you the hassle. You can also avail yourself very often those outfits that sell on a wholesale basis, like a Diodario, um, won't sell to somebody if they are on a wholesale basis if you don't have a resale number. So you can't get the benefit of a wholesale price on something that you're going to pass on to your customers. You're going to wind up having to buy it, retail on Amazon or something. And then, basically you're then just recovering the money you spend. Um, correct?
That's correct. Even Amazon now, you can set up a tax exemption with them.
Mm-hmm.
So
Okay.
if that's the way you do things, then you can at least save whatever the tax
Right.
is.
Yeah. With New York, I think the thresholds and you have to check in each state that you're in. In New York, the thresholds for how often you have to file your sales taxes um, depends on how much sales tax is going to be due. So if you're a small shop and you're running a small shop out of the second bedroom or something like that, and they would allow smaller entities to file annually if your sales tax due for a given filing period, meaning the year, if it were annual, falls less than, I think it's $3,000 or $3,500 a year of sales tax due, not transactions, not taxable transactions. So if you figure that in New York, depending on your jurisdiction that you're in, where we are in Westchester, the total cumulative tax, once you figure in state and county tax, comes to 8.375%, which only politicians can figure out how to get to the fourth decimal point when they're dealing with money. Um, but fifth decimal point, actually, 0.08735. So if you back up the numbers, in order to get to $3,000 a month at 8.375% sales tax, you would have to generate about $40,000 in sales in order to breach that threshold. So if you're not generating more than $40,000 in taxable sales, and that's a kind of that's not gross numbers, that's taxable sales. So in a case where we were when we first started, and I don't know if the threshold's ever gone up, to tell you the honest truth, because now that I think about it, I remember those numbers being about that. When we first started, when I was loothing, I was first started loothing, I started taking in repairs from a number of music stores, and I would go from store to store to store, pick up and drop off either once a week or once every 2 weeks, depending on how much activity a particular store was having. And I would take those guitars back to my shop. I would fix them, bring them back. I would get paid, and those stores were a tax exempt entity. So they weren't paying me the sales tax collection on those repairs because the service was then considered not taxable to them. Only if I was doing it to an individual directly were those sales taxables. Of course, I was also running a music school at the time, where I was running that out of my house, and later out of a commercial space. Um, Music lessons that were not considered taxable. So as a result, I was able to only file annually because the threshold was still not met, because all of those sales that were being generated were on a non-taxable basis. And I wasn't breaching the threshold of $3,000 in tax due. They said, well, you're too small to fool with. You can file annually. The first time in a given quarter that the quarterly sales, and it was then not a matter of whatever the amount is, that the quarterly threshold of, I believe it was, I don't remember exactly what it was, but you have to file quarterly if you go over that $3,000 a year of taxable sales. Otherwise, until you reach the point where you're generating $300,000 a quarter, you can either file quarterly over that they would say that $40,000 if that was the case. And that would be in today's dollars. If you go back, 20 something years ago, 30 something years ago, that $3,000 threshold, because you were, money was worth more and things cost less. I wasn't refretting a guitar for the same dollars 30 years ago that I was today. To reach that $3,000 in taxable sales today at $40,000 might have been, $50,000 or $60,000 back then, to reach the same net taxable sales. The Once you breach that $40,000 of annual taxable, then you have to file quarterly. You can then continue filing quarterly until your business reaches $300,000 in gross sales, gross taxable sales in a given quarter. Once you trip over 300 grand in a given quarter, then you have to start filing monthly. They don't want to fool with you to file monthly if you're reporting less than $300,000 in sales in the state of New York. So you can see this labyrinth of trying to figure out. But in your own given states, you have to determine what it is that you're responsible for. And I think that the operative lesson is that if anybody's flying without a net, just figuring that you're small enough that you won't be noticed, that if you just don't tell anybody, you won't be found out, is probably a mistake.
Yeah, I agree with that. Especially, like, I'm really surprised that the thresholds are that high in New York. I mean, they're not high at all in the state of North Carolina. So you're not really going to get away with much here. If they find out you're an operating business, even if you're a sole proprietor, and messing around, the NCDOR will find out,
Right.
more than likely.
Sure. Yeah, the New York State Department of Taxation and Finance is not pleasant to deal with. I've seen them close down businesses faster than you can shake a stick.
Well, one thing really quickly that you meant, I think you touched on it, was business to business. As far as sales tax, business to business, if I'm in the state of North Carolina, let's say, because I've had guys want to buy things from me and resell them, and I give them a good price. That I have another retail outlet that's like 30 miles away from me, and sometimes they run out of strings, deed area, or whatever. I'll give them a little discount, and then I'll sell them some strings to get them until they get their inventory back in, and I will sell them business to business, and I just put that on my form. I don't charge them sales tax because they're going to collect the sales tax.
Right.
So I take their form, and then when I fill it out, at least in the state of North Carolina, I report that in a different area with their sales tax exemption form.
Right. Yeah,
And
New York. In New York, it's called an ST-120, which is the sales tax certificate. The announcing or quantifying your ability to collect sales tax within the state.
right.
So that's sales tax. There isn't a whole lot to it other than, you need to know what your jurisdiction is. The other kind of tax we need to talk about is payroll taxes. You want to take a bite at that one?
Well, you're doing more of that than I am, really, since you're an S corp.
Mm-hmm.
I'm currently, with the LLC, I'm not having to do payroll tax until I file and then I pay my self-employment tax
Okay.
through that. So I'm not having to do things like deductions for Social Security, unemployment tax, and those type of things until I get to the year end and file my taxes as an LLC.
So you're reporting that income to yourself at year end as an LLC by filing what, a 940 or not a 940? Are you reporting that on your personal income taxes, or are you reporting that on your?
Well, I'm a single owner LLC, can use Schedule C.
Okay.
So I'll use Schedule C and report and pay all my self-employment taxes through that.
Okay.
So it's very straightforward. I know you're probably thinking, why isn't he doing this himself? But
So yeah. So you're paying self-employment tax on your 1040, through the Schedule C,
right.
which means you're actually paying both sides.
I pay both sides, but LLCs typically do.
Come again?
LLCs typically pay both sides. That's the advantage you have as an S corp,
Right.
is that you don't have to. Well, you can at least deduct one side. I have to pay both.
Right. So let me see if I can unpack that for everybody. As an S corp, and I wasn't aware that that wasn't the case for an LLC. But as an S corp, I'm an employee of the business. So is Sharon. We're our shareholders. In other words, we both own 100% combined of this business. However, when we pay ourselves, there are two forms in which we pay ourselves. We pay ourselves monthly. We take a certain amount of money as in the form of a paycheck that goes direct deposit into our personal account. When the business pays us our salary, it withholds our half, the individual's half of both Social Security and Medicare, which you normally see on your regular W-2, your regular paycheck. You see amounts withholdings for FICA, as it's known. I don't remember what FICA stands for, but it stands for something.
Federal Insurance something Act.
Okay. So that's where
I believe.
where the deductions for Social Security and Medicare are taken out of. That half of it is being paid by the employee, the other half is paid by the employer. Then, of course, you have your withholdings for federal income tax. If I'm in a 20% tax bracket or 25% tax bracket or 15% tax bracket for the federal income tax and the state income tax, which whatever tax bracket you're in the state income tax, those monies get withheld from your paycheck, and the company pays that directly to the state and to the federal government. In the federal government, that's on a 941, which is your quarterly withholdings and FICA and so forth, so such for the federal government. On the state side, that's called an NYS 45 form, that the income to the employee is reported for the state of New York, and that's where your withholdings for the state of New York are. And that's also where your unemployment insurance gets reported as well. The benefit to Sharon and I as owners of the business is that the S corp, the corporation, gets to deduct every amount of money they give me and Sharon, both through the form of our salary. So if I pay myself $2,000 a month or $4,000 a month or whatever the amount is, if I pay myself that, withhold the taxes, withhold the Social Security and Medicare on both sides, on the employer side and the employee side, the business then deducts that earnings, that amount of money, from its revenue. And it becomes 100% deductible in terms of reporting the bottom line. So if the income to the business was $300,000 in a given year, and you paid your employees cumulative of taxes and withholdings and FICA and Medicare, $100,000, what's then left over is $200,000 of reportable income. That, of course, then you would reduce by whatever other expenses it took to generate that income or to generate that revenue. When that gets reported to me as an individual, I still have to pay income taxes on my 1040. Whatever was withheld, you try to, figure out a way to keep from loaning the government free money all year long. But you set your amounts of withholdings in such a way that, when it gets reported on your 1040, you are then, you have less, taxes that you owe, and you don't owe a lot amount. That's the balancing act that everybody plays with their W-2 form, their W-4 forms. With an S corp, that self-employment tax that you're paying on both sides in the employer's side is known as Social Security and Medicare. It's FICA, and it's the employer's part, which they got to deduct off their taxes, which then gets reported to me as how much the S corp earns through its K1. In other words, what's left over is still passed through to me. However, it's devoid of those monies I earn through salary and withholdings, which is not taxable on the S corp side.
Right. And that's why this, like I mentioned before, about $150,000 of profit. That's why that's about where the cutoff is. It becomes really advantageous to get out of maybe doing the LLC, especially a single owner LLC like myself.
Right.
And now, as the owner, that's the thing. I have to pay both sides of my self-employment tax. But if I did have an employee, I can pay them just as you might pay them. The LLC would consider them an employee with all the payroll taxes and everything. But it's the ownership of the LLC, excuse me, that makes this calculation, one of the calculations, whether you stay in LLC or you go to an S corporation.
Okay. So that's that's kind of a general synopsis of what payroll taxes are. When you're paying yourself as a single operator like yourself, or you're paying, Sharon and I are paying ourselves, or if we had, hired more people,
I've always been concerned about
salaries
consumerism.
that you're paying to somebody, of course, are deductible to the corporation, the withholdings as they work out. Payroll taxes are one of those things that are also kind of one of these inevitabilities that everybody winds up paying. I hear stories time and time again where somebody says, "Oh, I'm thinking about hiring or having an apprentice, and we're going to do in the future. We're going to do episodes for Loothing for Dollars just on hiring and firing people." But from a tax standpoint, when somebody comes to work for you, the notion that you're going to hire somebody and quote unquote just 1099 them is a very, very dicey lake of thin ice to be walking on. Payroll taxes are one of these things that are kind of like sales taxes. If you fool around not doing them the way you should, you're just asking for a boatload of trouble to show up at your door one day.
Right. If you were to get audited and you don't pass the test for 1099, they're gonna hit you hard.
They're going to hit you very hard. The notion of 1099 is that you're a contractor. In other words, you're an independent contractor that all of the taxes to be paid out of those monies earned are the responsibility of the earner as an individual who's quote unquote in business for themselves. The thresholds to reach for qualification to be considered a 1099 are actually extremely pretty high. And there's a litmus test that they go through that, and we're not going to unpack all of that here, that um, probably 90% of people getting a 1099 in the mail are probably getting them erroneously as just an excuse for somebody to not have to go through the work of figuring out payroll taxes. The only reason why I know about it as well as we do is because even as a small business person, I've been audited twice by the Department of Labor of the state of New York, just as a guitar shop, because they take the notion of whether or not somebody's being paid properly, um, or as they should be as a statutory employee versus a 1099 employee very seriously. We've been audited twice over the years. We got through with flying colors, because we made sure we did things the way we were supposed to along the way. But that was an eye opener for me to have, some bureaucrat show up for an 8 hour a day, 2 day audit of everything under the sun. Twice over the course of 5 years. That was an interesting experience that maybe we'll unpack at some point. But
Too bad you couldn't charge him the bench fee.
I wish I could have. I wish I could have. So that's a general synopsis of payroll taxes. Let's talk briefly about doing taxes self-service. Self-service is the way I do them, versus the way you do it by outsourcing it to another individual, to somebody who does your taxes for you. And I want this to be more of a conversation than weighing the differences or weighing what's better or worse, because I think each person has to do it based on what's best for them. You alluded to this a little bit before, that you've got your bookkeeping in such a way that it makes it fairly painless to then be able to hand that package off to somebody else's, so you just don't have to fool with the filing.
Right. And then I just have another set of eyes that I completely trust, that it's gonna go through it and say, hey, maybe you didn't, you know, you can use this deduction because this year they just didn't, allow this. And so I'm like, maybe if I'd used TurboTax, it would have informed me, but on my own, I might not have caught that and not gotten the deduction.
Yeah, and I do use TurboTax. That's something I've used for a lot of years. I will say it's one of these things that, looking back on it, I don't know if it's something I would recommend wholeheartedly to somebody to do their own tax filings, because it is a fairly sizable commitment of time. Less so as the years march on. Every year I seem to promise myself that I'm going to start earlier and, make life easier on myself. And then I look up at the calendar and go, oh my God, it's March 10th. My taxes are due in 5 days, which is exactly what happened this year.
Well, but that's fine because you've been doing it for so long, and also your accounts are in order.
That's true.
That makes a huge difference. One thing that I didn't say before when we talked about payroll tax and sales tax is, one of the things that should keep you current on your accounting is realizing that the sales tax and your payroll taxes are payable to the government, and they don't like it when they don't get paid on time.
That's true.
So you better have that money for them, and just another reason to stay on top of whatever you're doing, however you're keeping track of it, staying on top. Don't look at your bank statement and go, oh, I got plenty of money here.
Right.
Without calculating the payables that you have outstanding. That, might be one thing if you owe I don't know, somebody that you're friends with that could turn out bad, but it's not going to turn out good if you owe the state or the federal government money.
Right, right. They want their money when they want it and when it's
Yeah,
due.
when it's due.
Yeah, absolutely. I had, it was just, I guess it was about 3 or 4 quarters ago. May have been less than that. I did my usual tax filings and I send them certified, return receipt requested, just because I want to be able to have proof. Several years ago, I remember getting a notice from the IRS that they received my one of my quarterly filings. I don't remember which one it was, and to tell you the truth, I don't remember if it was the feds or the or the state. But they said they told me in the mail that they received them late, and that I had no. They told me that I had filed late, and therefore I owed not only penalties of whatever $100 a day or $50, whatever it was, plus interest, plus penalties, plus. And here's this $1,700 bill that you now owe when it was only, whatever it was beforehand. And it was a small amount of tax. And I, out of paranoia, when that filing goes in, I not only send it return receipt requested and certified, when I slide that envelope over to the mailman and I go to the post office to do it, and I said, "Can you do me a favor? Can you do that? I want to see the postmark, that's on there, that it's on time." And then before he takes it away from me, I flip it around and I take a picture of it with my camera, with my phone, because I want to be able to tell that, no, I don't owe penalties or fines because I did file on time. By the way, the IRS is required by law, if you mail in your taxes. Nowadays, a lot of those quarterlies, a lot of those in New York State, they're all electronic filing now in New York. So it probably was the state that the feds that it occurred with, because it's odd that with the federal government, a lot of stuff is still going by mail, and a lot of it is not happening electronically. Income taxes are happening electronically. So the 1120S still now happens electronically. Same thing with your 1040s. Payroll taxes still go through the mail. They're not necessarily electronic. You can set them. I have tried to set them up electronically, but they haven't figured out yet how to let me do that. And I can't understand why. It's bizarre. It's Kafkaesque.
I've always
That's
been
crazy.
concerned
It is
about
nuts.
consumerism and the
So those
Western
quarterly
lifestyle,
filings
but sustainability
happen
was
through the
never really on
mail,
my
so I
radar.
make sure I have,
I got an email from a
documentation,
classmate asking
because
if I would be
several quarters
interested in
ago I
joining
got
her
this
on a research team.
notice that it was late, and I asked them to provide the postmark, telling me how late. They could not produce it because I knew that the postmark was postmarked before the due date, because I had my own evidence. And then I sent in my own evidence, and they dismissed the fine, and they ruled in my favor. It took about a year and a half to unravel, just for the stupidity of a postmark.
That's insane.
It is nuts. About last quarter or a quarter before that, I sent off my payroll taxes, did my usual, had them stamp it, took the picture, sent it, registered, return receipt requested. And then about a week after, or 2 weeks after the filing deadline had come and gone, I received the envelope back from the U.S. Postal Service telling me that, it was undeliverable because the addressee was unidentifiable. And I couldn't believe. I said, when an envelope is labeled IRS, Internal Revenue Service, with the PO box number as it's described for where it goes for the quarterly payroll taxes, how is that so how is the federal government not deliverable to?
I'm really not surprised by anything anymore when it comes to the Postal Service.
Oh my
I've got
God.
a lot of horror stories.
So
I'm
just,
glad I file electronically.
yes. Now, but with the payroll taxes, I can't file electronically, oddly enough.
Well, maybe I'll hold off on hiring someone then.
Well, looking back on it, the one of the things that even when I was, I've always been filing on my own, but one of there were two experiences I had when we first started paying a lot of payroll taxes, because at one time we were seven. So we had 7 people in the shop, so we were a 7 Looth shop, and so calculating the payroll taxes was cumbersome, because the way we were paying people was based on hours, and this person's hours were different than that person's hours. They were getting paid a different rate because they were working longer than that person. That person started as just a tech, or this person was paying more of a higher salary because he had a higher position or had been working with us longer. So payroll taxes were cumbersome at one point, and I did sometimes farm that out to somebody who would calculate that for me, then submit the forms to me for review, and I would sign them and file them. I got lazy at one point and was in the process of switching payroll tax accountants, because I didn't use a payroll service like Paychecks or something like that, because I still wrote the check to the employee. Um, and it was too much to try to do through Paychecks, because I found it expensive for the luxury. Um, and I had switched accountants at that time because my accountant had retired. Um, and I'd switched to a new accountant who had then taken it on. And I had gotten lazy. And during one of our phone conversations, he said, "Well, this is pretty much the same as it was, last quarter." And we had also reduced our number of employees at that time. So, and our payroll had become more standardized. He said, "You want me to just sign it and file it for you?" Sure. Biggest mistake I ever made in my life. Not because he screwed it up that time, but I got in the habit of letting him do it. And I didn't sign off on it. I would give him the information. He would mail me a copy after he filed it, because it had become standardized. Well, what I found out was that I was his customer. Very
Wow.
much like um, everybody whose guitar shows up on my bench is my customer. Now, you try to care about all your customers, but if you have 7 Loots working for you, and one guy strings up a Bigsby wrong, and it winds up going out to the customer without you seeing it, because a lot of times in a multiple Loot shop, you don't get necessarily to put hands on every instrument that goes back to the customer, and something happens. The guitar may be perfect, but you get a phone call from a customer saying, "Well, what is when can I just one question? When can I take that blue paper towel that's in the guitar out? Is that in there for a reason?"
Oh,
Well, okay, well, something slipped past me because I'm maybe not paying attention to everything that's going on that goes out the door. Same thing can happen in an accountant's office. I quickly found out that I was not a big client, and I was the person I was one of dozens of clients who he was doing filings for, that I got handed off to an assistant who was doing his number entry for him, and just putting in the numbers, putting in the numbers, putting in the numbers next, putting in the numbers next, putting in the I became a customer whose work was being done based on a data entry basis and just processing a form. In certain shops, you're just a customer. And I found out the hard way when I got a notice from the state telling me how much I owed. And I looked at the form and said, "This is wrong. Like, all of our income was accidentally reported on the wrong line for unemployment insurance. The way the state rules work, they don't offer refunds if you overpay your unemployment insurance. I had several thousands of dollars in excess funds put in. Now, unemployment insurance is like 1.5% in the state of New York of your total salary. So if you pay somebody $1,000 on a payroll basis, you know, 1.5% is, taxable, is on your unemployment, on your not unemployment insurance, your liability insurance. It's 1.5% on your liability insurance, or your liability insurance. It's the what do they call it? The disability insurance. Sorry.
Mm.
So New York State disability insurance that they require you to pay is only like 1.5% or something like that. She reported all of the taxes due, all of the earnings, just was stuck on the wrong line, and it just so happened to be the disability insurance line, and so they took all the money, and then said, "Oh, you still owe your payroll taxes for the payroll taxes due." And I said, "No, no, no, that was paid." And so we had thousands of dollars sitting in our disability insurance account with the state that they would not give back to us. And they said, you still owe the other taxes. And moving forward, as your disability insurance payments are due, we'll deduct that amount off of what's been overpaid. So I worked off of an overpayment basis of a credit on our account for years, because one mistake from an employee, from a guy who wasn't paying attention to his customer, me, because I was just a customer. I was just somebody who, so that's the one of the examples where if you're working with an accountant, it's still incumbent upon you to overlook their work. I got a guy can get you into a heap of trouble.
Yes, for sure.
So that's one half of it. That's from my argument. That's why I prefer to do it myself, because I looked at it and said, I can screw up my payroll taxes just as good as this guy did. So I might as well do it myself. And I taught myself how to do it. I already kind of knew how it was being done because I was getting the forms. But after a time, I got lazy and said, you know what, you can just submit it for me and send me the copies after. And I you get it, and oh, you filed my payroll taxes again, you put it on that pile over there. You don't necessarily read through right away. And then you find out later that something went wrong by mistake. The other thing that doing my own taxes has given me, from the standpoint of my business, is that it has forced me to put the focus of the earnings and expenses of my business in a light that I don't think it would have ever been if I was just having somebody else do my taxes for me, as in the form of a chore, just to shuffle off to somebody else. You follow?
Right. Yeah.
It forces you to look at your business in such a way that suddenly the earnings that your business generates become precious, and the expenses against those earnings, um, even though the game of figuring out what's expensible and what's not, to some people become almost an Olympic sport.
Yeah.
To find deductible, you hear all of those stories in the news every year about somebody having an emotional service pet that they're trying to deduct off their taxes or something like that, or taking yoga lessons and deducting them from their taxes, or whatever. But suddenly it put in perspective for me the relationship between earnings and expenses, and brought into huge question everything that the business was spending, whether it was even necessary to spend enough. Because if you're watching the earnings go out or the expenses go out after the earnings have come in, suddenly, for me, it put in perspective the relationship between those two aspects of it and how much, after all, I'm running a business so I can feed myself. The more I can have left over, whether it's after taxes or before taxes, is more important to me at the end of the day. Um, but in that sense, for me, it put into stark relief. It put the relationship between the earnings and the expenses of the business, and then filling out the tax forms became an exercise almost.
Right.
You know.
I can see that. I can see that.
So I want to talk quickly about some of the general principles of we already did, the general principle of sales tax of income tax, excuse me, like we said, is um, where you have revenue that's generated, um, and then you're categorizing and deducting that income by expenses. One of those expenses, I want to talk a little bit about tax strategies as it relates to the big kahuna, which is the income taxes. Um, do you want to take a swing at depreciation and amortization?
Well, I mean, if you're talking about, buying a large item and it has a life more than a year, you're not going to necessarily be able to expense that entire purchase in a year. You're going to have to extend it and whatever the life, there are tables that the IRS has for the life of a certain, like, let's say computers.
Mhm.
Then you're only going to be able to expense a portion of that purchase over whatever that lifetime is. It might be 7 years.
Mhm.
Um, so you'll have a cost basis for the item that you purchased, and then you'll split it up over the lifetime that you're allowed by the IRS to expense it.
Right, and
Uh,
those depend on the category of the
right, right, exactly. And so I have a building. I own it outright. I get to amortize or depreciate it.
Well, the difference
Cost of
between
it.
depreciation and amortization. Depreciation is uh, the expensing and reduction in value of
Right,
of an asset, of a physical asset. So if you buy a CNC, or if you buy a building, or if you have, if you go out and pony up for a plec or something like that, that's a big ticket item that you expense. That's an asset that you're expensing over the course of a number of years. And that's dependent upon the type of asset. Computers might have a certain lifespan as far as the government is concerned. You have to write it off over whatever it is, 7 years or 5 years or whatever it is. And that's an asset. Amortization has to do with intangible things, correct?
right,
You know, so that would be where you're expensing expenses, large expenses. You might have organizational costs. You might have leasehold improvements that you're doing to a space that you're just starting to open your business in. You might have larger moving expenses. You might have intangible things that are not tied to an asset, that are larger expenses that you need to expense over time, that are not an asset that you devalue.
correct.
Okay. Um, some of that from the tax planning standpoint. Now, I think when you're looking at a depreciation schedule of assets, um, you describe those as large assets.
Well, not necessarily large things that have a life of more than a year.
Right.
Because even if let's say you have a 3-year subscription to a business journal, if it's $150, but it's a 3-year subscription,
Mhm.
you're supposed to write off $50 for year one, $50 for year two, $50 for year three.
Right.
Although, there is what's called Section 179 that will allow you to expense things all in 1 year,
Yeah,
even if they're financed. So,
yeah, that's Section 179 is one of those things that they refer to it as Section 179 because it's Section 179
Section 179 of the tax code.
tax code. That's one of these things that people who are responsible for taking your money from you like to be able to trumpet as a gift back to you in the form of we're letting you do something with your money that otherwise, if we weren't so benevolent, we wouldn't let you do. To characterize it tongue in cheek, but the notion there is that if you have an expense now, when you say more than a year, I have a fretting hammer that's almost as old.
Right.
So,
I think it's probably safe to write that off. That's what I'm talking about, large. I mean,
yeah,
I don't
and I
remember
think,
the exact cutoff now, but it's like $300 or
and
something
there
like that.
isn't, and that's the point I wanted to bring up because it's not necessarily the size of the asset or necessarily the usable life. I think that the depreciation rules are probably purposely nebulous to a fault. But the notion is that if you have quote unquote a larger piece of equipment or some asset that you're purchasing that you're intended to use over a number of years, or happens to be a capital purchase where you're and the I think the intent behind it is the notion that it's some big piece of equipment, but it doesn't necessarily have to be a $20,000 CNC.
No.
It could be a $400 humidifier that you're going to be humidifying your shop with, and if you expect to last over a number of years. It could be, if you were going to go and get yourself so if you were going to buy an early wine neck check or a proper workstation or something like that, and you're buying a big asset or a tool that you're planning on using for a good long time, the expectation is that you have a choice of either writing it off over years as a depreciable asset, especially if it's something that does last for more than a year. I think they consider assets that last less than a year as your kind of consumable purchases. If you're
Right. Sandpaper.
sandpaper, wood, you don't necessarily, although there are some people who buy wood and have them for generations and then wind up having estate sales where they sell that wood to somebody else. But the activity of whether or not you're going to expense it within a year or under a 179 expense or carry it over a course of years is part of the planning of tax planning. In other words, you may not need the tax relief in a given year. You may be having a year where you had a particularly challenging year, and for you to have all sorts of extra 179 expenses that you then exceed the amount of taxes you owe, you may not even need the tax relief, and it may be in your benefit to forego the 179 expense and let that write off over a number of years. And as time goes on, it's almost like a stacking effect of, depreciable assets because we all buy tools. We all,
Right.
somebody comes up with something new, we feel we need to buy it.
Yeah. Well, each year with me, I mean, each year I've had more revenue, more income. So certainly there are going to be things that I'm like, well, if I expense it all now, I might like to have this next year and the following year.
Right.
So I don't elect to use the 179.
Right, exactly.
But also, I have to say, I do hear a lot of people talk about, oh, I'm going to go and buy all this stuff because then I can write it off and not.
Yes.
And it's like, well, But if you weren't planning on buying that anyway, and you're
Right.
just buying stuff to not pay just a little bit more in tax, you're actually still,
I used to
you're losing
share-
money.
Absolutely. I used to share a house with a keyboard player who and it was about every, I don't know, February or March or so, that suddenly all of this new gear, a PA system, keyboard stands, new keyboard cases, and all of this new gear would start showing up routinely. And, I'd say to him, I said, "What are you doing?" He says, "Well, my accountant said I needed the write-off." And I said, "Well, what do you mean?" He says, "Well, my accountant said to me, my guy said to me that I didn't have enough expenses, he told me to buy stuff that I could write off on my taxes." He says, "What do you think?" I said, "I think you need a new accountant, um, because if you're in the 25% tax bracket, hypothetically, and you are buying equipment to save yourself 25% in taxes, it means you spent 75% of money you didn't need to spend.
That's right.
Because it only saved you 25% of some earnings that you would have had. In other words, instead of spending, $400 on a speaker cabinet, you could have just sent $100 to the government and kept the other $300
That's right.
if you didn't need it. So
Yeah, people don't think about that.
yeah, having expenses for the purposes of reducing tax is a poor savings plan and that's not a financial plan. That's something that should definitely be said there from a tax strategy standpoint.
Right. On the other hand, if you were, I don't know, probably not going to come up with a good example, but if you were going to buy a big thing of sandpaper on January 3rd, you may consider bumping it up and doing it before the year ends. If let's say that you just expect that next year's income may not be as big, you might do that. But
Right.
but just going out and buying big items just because you think it's going to save you money, it's really not going to.
Right. Well, let's talk about the difference between then, because you brought up a point there. Um, let's talk about the difference between accrual accounting and cash accounting, because that has an impact on your taxes as well, right?
Right. I mean, accrual accounting is that if I can get all the definitions right, but for instance, if you have insurance that's going to last more than a year, you calculate that portion of the insurance you're going to use in the current year and write that off, and the rest stays as a prepaid expense on your insurance. It's you're not writing things off as they happen.
Yeah. So with cash accounting, you claim the income when you get it, and
You
you
claim the expense when
claim
you
the
pay.
expense when it occurs,
Right.
as opposed to accrual, which is you claim the income not when you necessarily get the money, but when you earn it. So in other words, you have um, if you have, say, a customer that gives you a 50% deposit on a refit and it's in December, but the refit doesn't get done until February, and the invoice doesn't occur, the balance due, until February, from an accounting standpoint, you didn't earn that money, that 50% deposit in December. It's claimed in February.
Correct.
So, you're earning the income when the transaction actually takes place, uh, not necessarily when you're getting the money. Or if you build somebody for a repair in December, say you're working for a music store and you reconcile with them monthly, and you give them a bill in December and they paid you in January, you actually owe the taxes on the money in the year that you've generated the invoice in December.
That's correct. You'll owe on whatever your profit is for your income tax, and your sales tax will have to be paid on that invoice that is created, even though they didn't pay you.
Okay. So that's something that in theory really only kind of affects you at the transition of a year. You know,
Yeah,
unless,
whatever your tax year is, which for most people is probably going to be at the calendar year.
yeah, most people would adopt for a calendar year. I think you have to make a special election for, you know, informing the IRS if you have a different financial calendar than the calendar year. Um, the I want to talk a minute about one other tax strategy that I've mentioned before, and this has to do with as it relates to um, oh, and just to finish up the conversation about the accrual versus accounting, versus accrual versus cash accounting. On the flip side of that, you claim the expense when when you incur the expense, not when you pay it. So,
Correct. Like utility bills are a big one. You're going to get whatever electricity bill, and you get it billed December 21st, and then you don't pay it until January 7th or 8th.
right.
You still get to write that expense off in the year in which you receive the invoice.
Mhm. So you pay when you get, so if you're like on a net 30 basis with some company and you get stuff in the mail, it comes with an invoice. It may not be due for months in advance, or if, like, for example, if you're doing warranty repairs for Fender and you get an invoice and they got you on a net 90 basis, that's 3 months later. I don't necessarily owe them, but I still can deduct the expense in when I got the invoice, or I have to deduct the expense at when I got the invoice, not when I paid it 90 days later.
Exactly. That's why the paper trail and inputting invoices as you get them is important.
Same thing goes when you're getting income from, say, warranty repairs from a company. If you invoice Fender or Taylor or Martin or whoever for a warranty repair, and then depending on which one of them you're talking about, they can take sometimes months to pay you back.
Yeah.
We
Yeah,
want
they're not
to
going to pay you
build
until they receive the invoice, and then they're going to take forever to actually pay it. So,
right. Or sometimes if you're working for a school district and you're doing repairs during the summer for a school district, you can invoice them, you know, after the summer, you wind up invoicing them sometimes in September or October, and then you may not even get the money until 3 months later. You're in a new calendar year, but you actually owe taxes on the money from when you earned it, not when you receive it on an
right.
accrual basis. However, if you maintain an inventory in your business, meaning you stock parts and you're claiming that inventory as an asset, which you have to do if you're doing an inventory. If you have an
Right.
inventory, by definition, then as far as the feds are concerned, you then have to do your accounting on accrual basis.
Right.
So that's something I wanted to mention there.
That's a good, I didn't think about that, but that is true.
Yeah. So one of the things I wanted to go back to was the difference, and this is just a tax strategy thing. If you're a sole proprietor, or if you're a sole proprietor thinking about becoming an LLC, working out of your house, which you got a shop outside of your house, I've got a shop outside of my house, so we're kind of in the same boat in that sense, where the business exists outside of the house, you know, so deductible expenses at the shop look a lot different than deductible expenses at the house. Because if you're
Correct.
eating out of your house, suddenly there's this lack of separation between you and the business. Even if you were, I mean, if in theory, if you had your shop in a commercial space outside of the house, you can still run your business as a sole proprietor if you wanted to and just file it on Schedule C. I think you'd probably be crazy if you did that, but you can if you want the simplification. And if you're running a business outside of your house, the just take for example, you decide that you know your time is better off at the bench in springtime rather than outside the building cutting the lawn at the shop. So you decide to hire somebody cut the lawn, prune the hedges, and keep the place clean and tidy out front. If you pay somebody outright to do that at the business, that's 100% deductible off your income.
That's right.
If you do that at your house, right, you're
It's
shaking.
not deductible.
It's not deductible. It may be deductible if you're then claiming some, and this is a deduction that's been around forever now. It was something that actually was created in the tax law within my scope of memory, that suddenly somewhere in the 90s, I think it was, there was this thing that you could claim that was called a home as office deduction. And you would claim expenses for running your house as part of a business expense if some of your income and or all of your income came from using part of your house as your office, aka our shop. So if you're loothing out of the house and you set your shop up in your basement, you set your shop up in the garage, you set your shop up in a second bedroom, a portion of your house is being used to generate the income by which you're claiming as income, and you get to deduct the expenses of the portion of your house that that shop represents off your taxes.
Right.
Some of that's easy because if your house is 1,000 square feet and the shop is 300 square feet, 30% of your mortgage payment or rent payment, 30% of your homeowner's insurance, 30% of your heating bills, 30% of your, whatever is deductible. Even if you did hire somebody to cut the lawn and prune the hedges, in theory, 30% of that is deductible. But it becomes a very nebulous line.
Yeah.
What is deductible and what isn't? You follow me?
Yeah. I mean, there are some different things that you use as a litmus test.
Mhm.
That's why that's why I call the accountant. Of course, I do have a home shop, but I really use it more for electronic stuff. I don't really use it much for my business. So
Mhm.
I'm not deducting that,
Yeah,
having a
yeah.
home office too. But you could have a satellite office, but then one of the tests for that is that you have customers come to your home and to your office. So, and not that I don't like my customers, I do, but I like having that delineation as well.
Oh, yeah.
So, yeah, I mean, maybe you could deduct that landscaping expense, but
It becomes much more difficult to do in the sense of having a home office, because then the criterion is that 100% of the use of whatever space you're talking about must be used for
for that purpose.
the generation of revenue. So if you have decided that I have my shop set up in the garage, but I do my bookkeeping in the den, so therefore I'm going to add that square footage to the square footage of the shop in the garage to the percentage of the house that I'm writing off. How much of the time are you using the den for business purposes versus how much of the time you're using for, just your own personal uses? Become into question. And that's something that has plagued small business people for, I think, to some degree, the work from home stuff after the pandemic has changed that to a degree, but there are still rules in place to deal with that. My recommendation for people who are struggling with that or trying to figure out that labyrinth is that there's a much easier solution. If you have your business and you form an LLC or an S corp, that by definition, according to the law, is a separate entity from you. Then you can decide how much rent you're going to charge
Right.
Guitar
Yeah.
Repair LLC to rent the garage from you. It is 100% rentable, and you can include in that expenses in the form of rent that you're going to charge the business. Well, I'm going to charge you X amount of dollars per month to rent the business plus the expenses that you're costing the household.
Right.
And your business writes a check, for rent to the owners of the house. Doesn't matter that it's you, it's a separate entity that's writing the check to you in the form of passive income of rent to you. You have to claim that income on your personal taxes, but then 100% of that rent payment to the household becomes tax deductible in the form of a deduction off of your income, your expenses earned.
Right. Well, that's something I haven't had to deal with.
Well, just because you have a shop.
But I mean that might be a good plan. It would definitely need to be your primary place of business, more than likely as well. Um, that's the thing. It can be a part of a room as well.
Mm-hmm.
But from what I've seen on like home shop things, you need to make as strong a delineation as you can, because if you are audited, you're at the mercy of the auditor and their interpretation. And if they see that, oh well, I see that there's a bed over there and it's in your it's in your section of what you're writing off, they're probably gonna not see that the same way you do.
Joe's Guitar Repair and Massage Parlor.
Yeah, or nap room.
um, so so from that standpoint, I think the notion is that there are ways to strategize, to be able to save yourself money on taxes. But the bigger point is that you need a plan. You need to do some accounting, um, and quantify and qualify those expenses. And probably the biggest piece of advice related to that is separation.
Right.
Have a
Yeah.
bank account, have a separate credit card, and that kind of thing.
Well, and just always having clear lines. I mean, I'll admit, I've gone to buy something before, and I have separate accounts and separate credit cards, but Bank of America likes to make everything look the same. So I accidentally used my business card for a personal purchase.
In terms of the visual look, yeah.
Yeah, the color was the same and everything. I just pulled it out and I used it, and then I realized when I was going through my statement later, I was like, oh, that's not a business expense.
Mm-hmm.
So I had to. I mean, you can do, like with an LLC, you can deal with it in a couple of different ways. You can just write it off as an owner's draw,
Mm-hmm.
and then it becomes a personal expense, and it doesn't affect your income statement. Or you can reimburse that.
Right.
So however you choose to do it, but it's like that's the thing. Mistakes happen, but make sure you clean it up.
Yeah. And like you said, separation, the delineation of your business entity from your personal assets are paramount. Having that separate checking account, having that separate credit card, and it's um, I almost pay for nothing in cash anymore.
Same.
Just from the standpoint of not having to bother keeping an accounting, because it creates another, and that's something I used to do when I was much younger in business, that I would have to head over to the music store to pick up strings, and and you just pay for things in cash. That um the keeping of receipts created another activity that now you had to do outside of that, entity of your checking account or your credit card. And like I said, the checking account to me thing was the funnel that everything got poured into. And then at the bottom, everything came out after expenses. And if you just kept them separately, doing your taxes was just a matter of just sifting through, making sure everything was categorized in the right fashion. You know,
Exactly.
as a I actually almost enjoyed doing my taxes better when I was doing them as a sole proprietor. Because it seemed like more of a game than it did as a corporation. And what I mean by that in a sense was that one of the tax strategies I employed at the time, mostly because of the nebulous nature of the tax code, was that at the time I was engaging in all sorts of different activities to generate what we would, from a business standpoint, call revenue. In real life, we just call money. So I was gigging, I was playing gigs, which of course is a very heavily cash oriented activity. So you get paid cash from gigs. I was having students come by who would be paying some for the lessons in cash, others would pay me. And there was a period of time after we formalized that and we were running a school, they were right then writing a check to the school. Um, and they were paying by check. We were getting cash from gigs. Um, I was doing repairs for customers, and there were later periods of time where I was engaging in other activities because as I got better at running a business and had friends of mine who were in business for themselves, whether they be plumbers or psychologists or whoever, would come to me saying, "Can you coach me on how to run my business?" I started another business coaching businesses how to run their businesses. And that created more revenue. And that, in my mind at the time, I was just doing all of these different things just to avoid getting a day job. Now realizing that it was all of these things were converging to create a career or to create an overall larger business. But at the time, playing gigs and the expenses you had doing that were a lot different from the expenses of running a guitar shop and doing repairs for people compared to the expenses of teaching people guitar or going to their homes and teaching people guitar and so forth and so such. So at the time, I actually ran a Schedule C for each one of the business activities we were in, which forced me into this labyrinth of trying to separate businesses from one another and making sure all of the income from that activity went into this account and all of the income from that activity went to this account and that activity went into that account. But it gave me the luxury of freedom of being able to say, well, if I were just looking at this overall business activity, that's a very questionable expense for that business. Who buys a guitar for a guitar repair shop if it's just a guitar? If you're not if you're not using it as a loaner, if you're not using it as a demonstrative piece you can't just write off a guitar just because you're a guitar shop because it has no purpose. It's not a business asset at that point. If
Right.
it's a personal guitar, but I could write off my personal guitar if I'm taking it to gigs and playing gigs with it and claiming the income from it. So that it in that sense it was more of a, dare I say, shell game than anything else. Then, like I said, as time went on and the business became more formalized, especially after we moved it out of the house and we became an S corp, then it became much easier to separate the business from me and have a delineation. And then even when I was gigging, then it was just that was a separate Schedule C outside of the business over here because there were things that would be deductible from the course of being a musician. The expenses to get to and from a gig, for example, and the gas and blah 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 blah. You wouldn't necessarily be able to expense over here. So that whole idea of just the accounting and keeping things separate was, like I said, more of a monopoly game than it was, in later years where it became more formalized.
Yeah. Well, um, you mentioned using a vehicle to travel. That's a good expense, but keep a log and,
Oh yeah,
only do it from your primary place of business and write down where you're going. Keep
right.
track of your mileage.
If you're in the and I think every every expense has its rules that you have to live by. So if you're doing guitar repairs and you're driving to music stores to pick them up and drop them off, of course you can write off the expense of getting to that store and getting back to your shop. However, if you leave your house in the morning, drive to the music store to pick up a guitar, or drop off a guitar, or pick up a guitar, and then drive to your shop, that's called commuting,
That's
which
right.
is no longer deductible. At least a portion of the trip from your home to the music store was not deductible. So there are, I mean, I think, the notion of being able to separate it, where if you have a separate entity makes those kinds of questionable deductions much less questionable.
Yeah, fortunately for me, I live a mile from my shop, so I could just spin in the parking lot and then go from there.
There you go. Well, our shop used to be 8/10 of a mile from our house. Then we moved here, and now we're 4 miles from the house. So, we've got we increased our commute by about, 400%.
Fortunately, it was a short trip to begin with.
Yes, absolutely. Absolutely. But yeah, I think you and I are probably on the same page in that sense, that you would probably have to pay me a pretty penny to live where I live again. Um, but that's a separate conversation.
Yeah.
This one was about taxes. And if everybody hasn't left or fallen asleep yet,
Yeah. How many people are left?
surprisingly, a fair amount of the people who joined us are. We had a few people.
I'm still here.
Does anybody have any
You've been
tax?
looking at the,
Does anybody have any tax questions for either myself or Franklin?
I got a question.
Shoot.
Yeah, thanks for the information. Appreciate it.
You're still awake. That's a good thing.
Yeah, yeah. So my question is, and I'm asking this for a friend. So, okay, well, I'll just spill the beans. I had a customer recently, and I've had this happen in the past where a, a client will order a guitar, and for whatever reason, they want to pay for it either substantially up front or even up in full up front.
Mhm.
So and not wanting to say no to somebody trying to give me money.
Which is you should never say no to somebody.
Yeah.
That's right. I usually say yes, but I hadn't really considered if somebody say pays for a guitar in full up front, and I'm not going to deliver that guitar for a couple years.
Mm.
What are the tax implications? How should that be reported? Should I consider that actually some kind of liability because, I've taken the money, I'm being paid for something that I haven't done yet?
Well, I think there are a couple of sides to that equation. I think that falls directly into the category that we were talking about before, the difference between accrual accounting and cash accounting. Do you know what you do in terms of your accounting? Do you know whether you're reporting on a cash basis or an accrual basis?
I believe it's on a cash basis.
So if it's on a cash basis, you always report the income when you receive it, not when you earn it. So you may be under contract with him to deliver a guitar 2 years from now, but that you receive the cash now means now is when the taxes are due on that money. So you
Okay.
are creating a tax liability for yourself now, but you also have the money now, which would be probably the best time to pay the taxes when you're flush. So if somebody gives you, 15 grand for a guitar, that you have the full 15 grand now. And if your tax bracket is, say, just for argument's sake, say you're in a 30% tax bracket, you're going to owe 5 grand in taxes on that 15 grand. If you were in a 33% tax bracket, which you probably aren't, you're probably in an effective tax bracket of 20% or less. But if you're, $15,000 times 20% is $3,000 possibly due on that taxes, or at least you're claiming the income on your balance sheet on the income side within that year. And then, of course, you deduct expenses against it to find out what your taxable income is after the fact. But if you're on a cash basis, it's always when you receive the money, not when you earn it. You may be under contract to deliver the guitar 2 years from now, but or just a general agreement. Do you build on contract, or do you just build on kind of a handshake?
It's a loose contract. I didn't have a lawyer write it up, but
Do
it's,
you just have a letter that says, I agree to buy such and such a guitar at such and such a time?
yeah, lists the specifications, the estimated delivery date, changes in
that-
specifications, changes in price, things like
That
that.
by definition then is a contract. It's not, it doesn't necessarily have to be written up by a lawyer. You have a written agreement between two parties. So there you have a contract that if you were on an accrual basis, you would actually have to report the income when the contract is signed.
Hmm.
You follow me? So it's almost in your benefit to try to receive as much money up front as possible, because in theory, if you were on an accrual basis, which you're not, you're on a cash basis, but in an accrual setting, once that was agreed to, signed, that you're going to be building such and such a guitar, even if the delivery date is out there by law, if I'm not mistaken, and Franklin can correct me if I'm wrong. When you signed the contract is by law considered when you earn the money, not when the
Oh.
guitar is delivered.
Even if I haven't received, say, the
Even
final
if you haven't
payment.
received the dime yet. But
Okay.
that would be determinable under whether or not that build letter was considered a contract.
Hmm.
You follow me? But since you are on a cash basis in terms of your reporting, you pay when you get. So if they give you 50% up front, you don't owe the taxes on the other 50% until you get, that other money's when the guitar is delivered. But if somebody's, says, hey, you know what? I got this money burning a hole in my pocket now. I don't want to worry about, whether or not I'm flush 2 years from now when the guitar's done. When the guitar's done, I just want the guitar. Let me give you your money now and pay you 100% up front. That from a tax standpoint, you owe when you get. Am I wrong, Franklin?
On a cash basis, that's definitely true. I don't know as far as just having a signed contract what that means for an accrual. I mean, normally, of course, I've never had anybody say, hey, here's 15 grand for for a guitar up front. Sounds like a good problem to have. You know, uh, Taking a payment, if you're doing accrual, just strictly from an accounting position, if you take a payment and you don't have an invoice created, it creates a liability on your books,
Mhm.
showing that payment. But I don't know the ins and outs of whether just the signed contract and you taking the money effectively, if you were doing accrual basis accounting, would therefore trigger all the income being due. I mean that in that year. But that's why I submit my stuff to an accountant and talk to her.
All right.
But I think
Thank you.
from the standpoint of Michael's question, I think that if he's reporting on a cash basis and he gets all of that money up front, that's when those taxes are due.
Yeah.
The other side of that equation is what kind of agreements do you have, Michael, with your customers in relationship to the completion of the build? In other words, if somebody gives you a huge chunk of money up front for a build and then is either unwilling or unable to complete the contract when the money's due or the guitar is done, how do you deal with that?
So in other words, somebody say has paid for 50% of the guitar is done, and now they don't want to pay the balance.
or you can't find them.
Yeah.
Hmm.
Fortunately, I don't have an answer to that because I haven't had that happen.
Okay.
Doesn't mean it won't happen at some point, but
But in your contract, do you have that your deposits are non-refundable?
I have that the first deposit is non-refundable. Then when I start construction, I take a 50% deposit, and then the balance is due upon completion of the guitar.
Okay.
So at that point, if somebody's, going to step up and give me the 50% to actually start making sawdust, I've always assumed, and it's proven to be the case, that they're in deep enough that they're gonna, want the guitar at the end of it.
Right.
You've never had a circumstance where somebody's ordered a guitar and then you've heard from them saying, well, my circumstances have changed and I really can't. I really can't.
I've
Sure.
had that happen to me several times on the first deposit, which is much smaller. It's yeah, and some people have asked for their deposits back. Some people have just said I can't continue, and I understand the deposit's non-refundable. Best wishes.
Okay.
Yeah, I don't know exactly, but it seems to me that if your deposit is refundable, that may change the that scenario as far as having to claim all
Yeah.
that as a sale.
Okay.
Yeah. I think
But yeah, that's definitely something if I were you, I would take to a CPA. And I don't know if you have a lawyer, you could stiffen up your contracts. I don't know. That can scare people away as well, but
Yeah.
just so that all the loose ends are tied up.
Okay. Well, thank
yeah,
you.
it seems to me that you would want to probably tighten up that bill letter, because from purely in a cash basis, if you owe taxes on money when you receive it, if arguably there's a contract between two parties where that money or some portion of those monies given up front would be refundable under certain circumstances, from an accounting perspective, it would seem to me that refund, if it happened in a later calendar year, would then trigger a deduction against income in future years if you're on a cash basis, not necessarily not reportable when you got the cash. Because just like, say, for example, a very forgotten about or very overlooked deduction in the form of a tax write-off or a tax deduction that people overlook often are discounts. So, say, for example, your standard purchase price for a guitar is demonstrably, say, you get $15,000 for a guitar, or whatever demonstrable amount of money for a full price guitar with these kinds of appointments and this kind of wood and this kind of accoutrement. And you have a customer that you've worked with several times and you're looking to ingratiate yourself to them. They've come back to the well a number of times and you've got a good relationship. Say, you know what, I'm gonna give you 20% off this guitar. I'm gonna give you 10% off the next guitar you order. Then they come back and they avail themselves of that discount. If you charged $15,000 for a guitar, or if it's demonstrable that $15,000 of a guitar is what you would have charged, and you wind up giving them, say, 15% or say 10% off of that guitar, you can write $1,500 of that lost money off of your earned income as a business, because you can demonstrate the fact that you incentivize the customer by reducing what they would have paid otherwise. Or, for example, say you have a repair customer and they are the repair customer from hell. You told them it was going to take 2 to 4 months for them to get back their guitar. And then 2 weeks later, they're calling, is my guitar done yet? How are we doing? Just checking in. And they send you 14,000 emails. And I'm just talking about stuff I've heard about, nothing I've experienced, of course.
Sure.
But then you have this customer that becomes a difficult customer, and you've quoted them for all of the work that you're doing on a particular guitar. Say you're doing neck reset and frets and this, that, and the other thing. Let's say you've quoted them $1,000 or $1,500 for a repair bill, and they've become a difficult customer, and you just want them out of your life. And in order to try to end things in such a way that you give them a little bit of meat off the bone just to try to make them happy. You say, you know what? I understand things haven't worked out as well as we wanted to between us. You're not happy. I'm not happy. I'd prefer to have happy customers. I'm going to knock 25% off your repair bill just to make you happy. In my head, that translates to just to get you out of my life. In that case, if I had a $1,500 repair bill, and I knocked 25% off the repair bill, and that's demonstrative, I can take that $375 and write it off of my taxes, even though I didn't earn it, because it was money I gave up in order to reduce a customer's otherwise 100% bill, in order to either make a customer problem go away, satisfy your customer, reward a customer, or incentivize a customer. If you run a special where you say during the month of April, we're going to give 25% off all setups, and that's demonstrable, you can write off the money you would have made if it weren't for the discount as a tax deduction against, and that's an often overlooked deduction. So as it relates to the circumstances you're in, on a cash basis, if you took the money for a repair and owed the taxes on it because you took 100% of the repair, or 80% or whatever, 100% of the bill, up front, and then in a subsequent year, the customer came back to you and says, my situation has changed, my, sob story, this, that, and the other thing, I really can't afford the guitar, and you agree to give him some or all of a portion of his money back, then you would be able to claim that refund to a customer against current income. So even on a cash basis, on a contractual basis, you have a way to reclaim the tax liability in future years. But in relationship to the question you just asked, that money would trigger a tax liability to you in the year that you received it.
Okay,
Also,
thank you.
Also, one thing, Michael, don't forget, like I assume, I don't know the state, I know you're in Colorado, I don't know what the state sales tax rules are, but if you trigger a sale like that, you also trigger normally all the sales tax due as well. So that could be a sizable amount of money.
Yeah. Well, for better or for worse, most of my sales are out of state, so
Well, that's good.
I don't have to worry about the sales tax. But I did. This is what my accountant told me, and that because recently I had a local customer, and he was putting in his 3 payments for the guitar, and he just wanted to give me like an even amount of money, say $5,000, and then I was trying to like back calculate what the sales tax was, but she told me to just collect the sales tax once on the full price of the guitar at the end, which may or may not be correct based on what you're saying.
Well, typically you would, like if he just came in and you had the guitar on the wall and it was $15,000, you would do one invoice for that price, and all of that sales tax would be calculated on that. So yeah, I think that's true. Just because they're paying in installments doesn't necessarily mean you don't have to pay the sales tax up front.
Okay.
That may change from one jurisdiction to the other, but if this, generally speaking, most states, if the transaction is taking place, within the resides of the state, in other words, if it's local to you, and you're within the state, the sales tax due is based on the size of the transaction, not the installments of purchase. You know, in other words, if somebody's paying you $15,000 over 3 installments, and they got to walk out with the guitar as the first installment, and they owe you, you know. Now, I don't know if the circumstances change in the case where he might be paying you $5,000 and only being able to walk away with the guitar at the end of the final payment. That may be what's triggering her suggestion that you pay the sales tax at the last transaction.
Okay, I'll ask her about it.
Yeah, it's worth asking the question whether or not you've got a liability, one or the other.
Yeah, all right. Well, I'm sure there are other questions, but if nobody has another question, then I'd have another question, but I'll step aside.
Does anybody have any other questions before we get to Michael's other question?
I have a question.
Shoot.
Hopefully it'll be quick. So
Everybody, just know we have to have liability on these questions. Everybody just understand that you really need to contact professionals at the end of this. Don't just run out and do what you hear here.
Absolutely.
With all due respect to Franklin and Doug, just please talk to a professional.
Yeah, we should put, like, when you send this out to everyone, there probably should be a disclaimer at the very beginning.
Okay. Okay, go, Michael.
my question would be, so like, obviously if you're already a business and you go out, you buy a bandsaw, that's something that is an expense for your business, is deductible. So let's say you're just Mike Hanerhoff, you're just a guy who's just sitting here, he doesn't run his own business, but he has all this equipment, he has all these assets, he has all these materials and things. And tomorrow I go out and I start my own business. Now I'm, Mike Hanerhoff Guitar Repair LLC or whatever. Obviously, it's always confused me how, like, okay, your business is one entity and you are a different entity, you're separate. But now I'm starting this business, I'm bringing all these assets that the business doesn't technically own. I technically own all this stuff. It's my personal stuff. Now I've started this business and I want to use all this equipment for that business. Can you, like, sell the equipment to your business? Is that a good idea? Is there any benefit? Like, should I wait to buy a new bandsaw until I start a new business?
You want a new bandsaw? Is that what you're trying to tell us, Mike?
I mean, hypothetically, I'm just saying, like if you have this equipment that the business is going to use, is there some way to account for that?
Well, there is a way to account for it, and I'll take the first swing at this one. Two things to consider here is, if you are starting a business, Mike's Guitar Repair, and it's becoming an official business outside of, say, your relationship at Elderly, and you're going to be doing it, whether or not you're doing it in your house or whether or not you're doing it in a commercial space. Some of it has to do with whether or not the business becomes its own entity. In other words, if you're just going to start, doing a business activity, accepting money for it, just as an individual, then you're a sole proprietor, no matter what DBA, doing business as, you register at the local county is. In other words, you're a person engaging in business and people are giving you money. That's an individual. If you set up an outside entity, say it's an LLC or an S Corp or whatever it is, that becomes, as far as the state is concerned, its own entity. It's a business that exists outside of you, because it is a business that can be transferred away from you to another individual. Somebody gives you a certain amount of agreed upon money, you can transfer all of the shares in that business to that other person, and the business can exist without you. I run this business. I'm a shareholder in this business. if one of us, Sharon or I, which are the only two shareholders in this business, predecease each other, the other one, according to our wills, inherits all of the shares of that business. Then if I die, or the one that's left dies, this Guitar Specialist Incorporated next January, or next March, is still going to owe a tax return if I'm still, and even if I'm not here, or whether I'm here or not to fill it out, because the business exists outside of me. So that is part of the answer to your question in terms of what form the business is going to be in. As it relates to your question of the deductibility of that stuff that you're going to use in the business that was purchased prior to the business activity, that falls under the aegis of depreciation and amortization, which means you get to write off the business's assets during the course of business. If you owned, for example, that bandsaw personally, before the business started using it, even if your business is a sole proprietorship, if you bought it prior to the use of it in business, you can still deduct it as a business use. The requirements are as A, you have to have written records of the purchase. You can't just say, oh yeah, well, I bought it at Sears when Sears was still open, and it was $300. You have to have a piece of paper that says this was the purchase price of that instrument or of that tool. You can transfer the ownership of that item to the business for $0, start using it in the form of creating income. That then becomes a business asset that you do what's called placing in service at the time you start using it for the business, even if the purchase date was some time before even the business's entity beginning or the business use of it was beginning. I could have bought a tool that, let's say, I purchased before I moved to this shop. I purchased a, a buffing wheel before we moved in, and I bought it a year and a half before I moved into the new shop because it was on sale over at Stu Mac, and I decided to buy it then. And then it sat in the box for a year and a half while I was setting up my new shop. And I didn't get my shop open to, then eventually I start using it in my business. That's when the item is placed into service. The purchase date may be all the way back here, and the purchase amount may be X, but I placed it in service at a certain date, and that's the beginning of what Franklin was referring to before as the usable life of that depreciable asset. So you can transfer those items to the business. In some cases, if you have a lot of assets that you're transferring to business use for the first time that determined or that preceded the business's entity, in terms of its business activity, you may need to report those assets as startup expenses. In other words, capital in. And capital expenses, large equipment purchases, leasehold improvements, organizational costs, what you had to pay to the lawyers to start up your LLC or to start up your S corp, all of that stuff has to be written off over time as what's called an amortized asset. Sometimes it's called leasehold improvements if you're starting a new business in a commercial space. If you decide you're going to move into a shopping center and you move into a space and the first thing you do is put down floors and put up paneling and paint and lights, and you spend all sorts of money outfitting the place, you don't necessarily get to write off all of those expenses in your first year because they're either capital improvements to a space or what's called leasehold improvements that you then have to amortize over the course of time. It may be up to 7 years or something like that. Same thing goes for those pieces of equipment. You would place them into service even if the purchase was years before. And of course, there's there's a common sense test, saying, if you do get audited and they look down and say, well, you placed this bandsaw into service in 2026, but you're saying your grandfather owned it in 1938. It's probably not going to pass the smell test.
That's actually pretty close to the reality of my bandsaw. So yeah.
Now
Well, the other thing to consider is you don't want to say, well, I placed this into service 2 years ago and I haven't made a dime. So you need to start, like I would say, if you want to be seen as a real business and an ongoing concern, then get yourself at least some revenue started.
Mm-hmm.
Because if you don't take in much revenue or any revenue and you're writing losses off and all this stuff, you'll be deemed a hobby.
Yeah.
Yeah. Now the other opportunity there is that if you set up a business, Mike's Guitar Repair LLC, and Mike's Guitar Repair LLC is going to purchase from you your bandsaw for $400, you have to show that it legitimately paid you $400 for that bandsaw and show the transaction. And then you have a $400 expense to the business that you could write off of income. Remember, write-offs, and you use the term write-offs, is because you're writing it off against other income. If there's no income there, it's hard to have a write-off. Because you would have capital in most businesses. There's capital expenditures that take place as upfront money, but those expenses very often are required to write off as a capital expenditure over time, and they're typically called startup expenses. But you can do it one of either way. You can either place something into service later if it's a recent enough purchase, or if it's something that you're just going to say, you know what, all of these tools I'm going to sell to the business for X amount of dollars. You show that transaction from the business checking account to you personally, and it creates two events. It creates a business write-off for the business, but it also creates income to you that you have to report on your 1040 for personal items that you sold. It's no different than you selling that bandsaw on eBay. That if you decide to sell it on Facebook Marketplace, you're supposed to, in theory, be claiming that income to the federal government as a sale of a personal asset. You can then report the sale as $400. I made $400 by selling my bandsaw. Coincidentally, I can prove that I spent $600 on it, so it's considered a loss. Therefore, you wouldn't owe taxes on that $400, but you have to then show the two, and it becomes kind of that really starts to feel like a game of Monopoly. But it's part of that whole. Who was it? I think it was. Was it Will Rogers that said that the U.S. tax code has created more liars of the American people than the game of golf? Wasn't he who said that? But yes, and the answer to your question is that there is a way for you to write off the use of that equipment, provided you're able to show a transaction that that equipment cost money. You can't just pull an item out of the garage that has no paper trail and claim that it cost, yeah, that's a $300,000 bandsaw that I, decided to write off over against my income, But yes, there is a way to do that. Sometimes it's better to have a plan that is accountable, for the lack of a better word, than it is to try to figure it out after the fact. So if you're thinking about doing something like that, some advanced planning might be a better off way to do it. And that's something where, just like I said before, having my my board of advisors, my tax accountant, a regular accountant, my tax attorney, my regular attorney, those are people I have in my life, even though I don't necessarily use them on a daily basis. We sat down with our corporate attorney last year. We hadn't spoken to him in 2 years because I didn't need him, but he's there when I have a question. Same thing with I have about two accountants right now that I work with. In spite of the fact I've got two CPAs who are CPA MBAs in my family, my brother-in-law and my sister-in-law on my wife's side, who are accounting professionals, and we've never had a tax conversation just because I don't want to do that at Thanksgiving dinner. But if I have a question like you have, I would come up with a plan and then discuss it with my accountant, saying what's the better way for me to handle it from a tax standpoint. What's the most advantageous thing? And to Franklin's point, you have to have income against which to write it off.
Thank you.
You're welcome. Any other questions? Do you have another question, Michael, or does somebody else have a question?
I do have another question if nobody else has one.
Fire away.
All right. So I asked my CPA this many times over the years, and I never liked her answer. So I'm asking you.
We'll give you another answer.
All right, good.
Give you an answer that you like.
All right. So, I've had on occasion to do warranty repairs, and I don't charge the customer anything for it.
Warranty
And
for a manufacturer?
oh no, for my own guitars,
Oh, okay. Fair enough.
like whatever, they had a crack or something,
Mhm.
and and my accountant has told me that since I sold the guitar with the warranty, that the work that I do on the guitar is not the warranty work I do is it's not an expense to me. It's not deductible. And that because I'm doing the work, but if I paid for somebody else to do the work, then I could deduct the cost of that. Any thoughts on that?
I'm sorry to inform you that your
Uh,
accountant, your CPA is absolutely right.
okay.
You if you sold the guitar under contract as a Bashkin guitar that comes complete with warranty. In other words, there's no, if anything goes wrong with the guitar, we warranty the guitar against defects in materials and manufacturing and all the other catchphrases that goes with it. That was inclusive in the price, meaning you earned the money for that warranty when you sold the goods. If later you have to perform some service on that, and of course it costs you your time, you don't get to bill yourself that amount of time in order to generate a tax event. In other words, it would be like sending yourself a bill to fix your own faucet in the kitchen. Very often when in our own shops, we're taking care of, minor stuff on our own. If I got a, doorknob that needs to be replaced, I'm not necessarily I know how to use a screwdriver and I can buy a doorknob to replace it at Home Depot. I get to write off the doorknob. I don't get to invoice my own company for the time it took me to replace. But if I hired somebody to replace the doorknob for me, it creates 100% expensable item. Same
What if
thing
you
goes with your warranty repair.
What if you
Okay.
really quick formed a doorknob replacement LLC and quickly went into business replacing doorknobs?
That would be an expensive thing to create. What did it cost? Like $1,000 to create an LLC or something?
Oh, I don't think so because
No, it's not that expensive.
Not that expensive anymore?
It's just, well, in the state of North Carolina, it's a $200 a year fee.
Oh, okay.
But the
I
startup is.
don't even think it's that in New Jersey.
North Carolina's not as good as I thought it was.
So
So
a red state. What's going on down there?
if you did have to hire an employee in order to effect that repair, of course, then what you paid that employee to effect that repair is certainly deductible because it generated an expense to your business. The notion of the fact that you sold it for under warranty does not create a taxable event for you. And of course, if you hired somebody else to do the repair for you, then of course, whatever you paid them, but of course, that's costing you money out of pocket. So that's not the best of circumstances either. But I think she's 100% right in that circumstance. It would be hard to generate a taxable event for the purposes of that.
Okay, thanks for the clarification.
What you could do is be like Martin and just tell him, I'm sorry, this isn't in the parameters of the warranty.
Yeah.
All right.
Are there any other questions that anybody might have?
Everybody's asleep.
Everybody's asleep.
Can I go watch the next episode of Severance?
You can.
All right.
Oh, yeah.
Hey, everybody that is still standing, unmute and thank these guys for dishing the dirt on some of this stuff. Even if you're just like getting, rubbing up against this stuff frequently, like just getting it in your head and thinking about it over and over again. Man, you don't have to understand it all at once. So yeah, thank you, Doug.
Thank you, fellas. Appreciate it.
Thank you.
Thank you.
Yeah, thanks. Thanks so much,
Thank you.
Doug.